Over the past few years, Canadians have taken on over $2 trillion in mortgage debt, making the country one of the most indebted housing markets in the world. For decades, people believed one simple rule: real estate in Canada only goes up. Homes were seen as the safest investment, a guaranteed path to wealth. But suddenly, something has changed. Mortgage payments are exploding, homeowners are struggling to keep up, and economists are warning that Canada may be entering the most dangerous housing phase in its modern history. Across the country, families who once felt financially secure are now facing a brutal reality. Some homeowners are seeing their monthly payments jump by hundreds or even thousands of dollars overnight. Others are approaching mortgage renewals that could double their payments. And the most shocking part? Millions of Canadians are about to hit this wall at the exact same time. So what exactly went wrong? Why is Canada's biggest mortgage crisis suddenly getting worse? And could this be the moment when the country's legendary housing boom finally begins to crack? In today's video, we'll break down the 10 powerful reasons behind this growing crisis and what it could mean for homeowners, buyers, and the entire economy. Number 1. The massive interest rate shock. For years, Canadians lived in what many economists now call the cheap money era. Interest rates were extremely low, mortgages were affordable, and borrowing felt almost effortless. People rushed to buy homes because monthly payments looked manageable, even on very expensive properties. But what many homeowners didn't expect was how quickly this situation could change. When inflation began rising sharply, the Bank of Canada had to react, and it did so with one of the fastest interest rate increases in modern Canadian history. In a very short time, interest rates jumped from near historic lows to levels not seen in over a decade. For many homeowners, especially those with variable rate mortgages, this change hit like a financial earthquake. Every time the central bank increased rates, mortgage payments climbed higher. Some families suddenly saw their monthly housing costs increase by hundreds or even thousands of dollars. What once felt comfortable quickly became a heavy financial burden. But the real danger isn't just today's higher payments, it's the cumulative pressure building across millions of households. Imagine budgeting your life around a $2,000 mortgage payment, only to see it climb toward $3,000 or more within a short period. Suddenly, everyday expenses like groceries, utilities, and transportation become harder to manage. Families are cutting spending, dipping into savings, or even taking on more debt just to stay afloat. Economists often warn that housing crises rarely begin with one dramatic event. Instead, they start with slow financial pressure building beneath the surface. Rising interest rates are exactly that kind of pressure. And because so many Canadians bought homes during the ultra-low rate period, the impact is spreading across the country all at once. In simple terms, the era of cheap mortgages is over, and the shock of higher interest rates is now exposing just how fragile Canada's housing system may actually be. Quick favor before we continue. If you find this breakdown valuable, drop a comment below with the word housing so we know you're watching. We put a lot of effort into researching these videos, so please subscribe to the channel. It's just one click, but it helps us keep bringing you deeper insights. Number 2. The variable mortgage time bomb. During the years of ultra-low interest rates, millions of Canadians were encouraged to choose variable rate mortgages. At the time, it seemed like a smart financial decision. Interest rates were incredibly low, and many experts believed they would stay that way for years. A variable mortgage often came with lower initial payments, making expensive homes suddenly look affordable. For many buyers, it felt like an opportunity they couldn't miss. But here's the hidden problem. Variable mortgages change when interest rates rise. Unlike fixed mortgages that lock in a stable payment, variable loans move with the market. So when the Bank of Canada began aggressively increasing interest rates to fight inflation, those mortgage payments didn't stay the same. They started climbing, and in some cases, climbing very fast. For many homeowners, the change didn't happen all at once. Instead, it felt like a slow financial squeeze. Each rate hike added a little more pressure. Monthly payments increased, budgets tightened, and savings began shrinking. Some borrowers even reached something called a trigger rate, a point where their payments were no longer covering the interest on the loan. When that happens, lenders may force borrowers to increase payments significantly or make large lump sum adjustments. Imagine buying a home when interest rates were around 1%, 2%, only to watch them climb past 5% or higher within a short time. Suddenly, the mortgage that once felt manageable becomes one of the largest financial burdens in your life. This is why economists sometimes describe variable mortgages as a time bomb. Everything looks stable while rates stay low. But when the economic environment changes, the financial shock spreads quickly across thousands, even millions, of households at the same time. And right now, that pressure is building across Canada's housing market. Before we move to the next reason, let me ask you something. Do you think Canada's housing market will crash or recover? Drop your opinion in the comments below. And if you appreciate the research behind these videos, please subscribe to the channel. It's just one click, but it helps us keep creating content like this. Number 3. Canada's record-breaking household debt. For years, Canada has quietly been building one of the highest household debt levels in the world. In simple terms, Canadians owe an enormous amount of money compared to what they earn. According to economic reports, for every $1 of disposable income, Canadian households owe well over $1.70 in debt. A huge portion of that debt comes from mortgages. During the housing boom, rising home prices pushed people to borrow more than ever before just to enter the market. Buyers stretched their budgets, took on larger loans, and assumed that future price increases would make everything worthwhile. As long as homes kept rising in value and interest rates stayed low, the system seemed stable. But beneath the surface, this growing mountain of debt created a very fragile financial structure. The real danger appears when the economic environment suddenly changes. When interest rates rise, monthly payments increase. At the same time, the cost of everyday life, like food, fuel, and utilities, also climbs due to inflation. For households already carrying large mortgages, there isn't much room left in the budget. Even a small increase in expenses can push families into serious financial stress. Imagine balancing your finances on a tight rope. Everything feels manageable as long as conditions remain perfect. But once the wind picks up, higher rates, rising living costs, or job uncertainty, that balance becomes incredibly difficult to maintain. This is exactly the situation many Canadian households now face. Economists often warn that high household debt makes an economy more vulnerable during financial shocks. And when millions of households are carrying large mortgages at the same time, even small changes in the financial system can ripple through the entire housing market. In other words, Canada's record debt levels may be turning what was once a booming housing market into a system under serious pressure. Quick question for you. If mortgage payments in Canada keep rising, what do you think will happen next? Price drops or market recovery? Share your thoughts in the comments. And if you appreciate the effort behind these deep dives, please subscribe to the channel. It's just one click, but it helps us keep making videos like this. Number 4. The mortgage renewal shock, coming between 2025-2027. One of the biggest threats to Canada's housing market hasn't fully arrived yet, but it's getting closer every month. Between 2025 and 2027, millions of Canadian homeowners will face something economists are calling the mortgage renewal shock. During the pandemic, interest rates dropped to incredibly low levels, sometimes as low as 1–2%. Many homeowners locked in those rates for a few years, believing borrowing costs would stay low for a long time. But those low-rate mortgage contracts are now starting to expire, and when homeowners renew their mortgages, they won't be renewing at the same comfortable rates. Instead, many are facing rates that are 2, 3, or even 4 times higher than what they originally signed for. This sudden jump could dramatically increase monthly payments for millions of households. To understand the scale of the problem, imagine someone who bought a home in 2021 with a mortgage payment of $2,000 per month. When that mortgage renews at today's interest rates, their payment could rise to $3,000 or even $3,500 per month. That's an extra $12,000 to $18,000 every year just to keep the same home. And this isn't happening to a small group of people. It's happening to millions of mortgages across Canada over a short period of time. Economists worry that this wave of renewals could create massive financial pressure all at once. Some homeowners may be forced to cut spending, refinance, sell their homes, or downsize simply because the new payments are too high. Housing markets often shift when large numbers of homeowners experience financial stress at the same time. And the upcoming mortgage renewals could become one of the largest financial tests Canadian homeowners have ever faced. In many ways, the real impact of Canada's mortgage crisis may still be just getting started. Now we're curious about your perspective. If your mortgage payment suddenly doubled, what would you do? Tell us honestly in the comments. And if you value the research behind these videos, please subscribe to the channel. It's just one simple click, but it helps us continue creating content like this. Number 5. Falling home prices are creating negative equity. For years, Canadians watched home prices rise almost non-stop. Buying property felt like a guaranteed win. Many people believed that no matter how expensive a home became, its value would eventually climb even higher. This belief encouraged buyers to stretch their finances, take larger mortgages, and enter the market as quickly as possible before prices climbed even further. But housing markets don't rise forever. Recently, some parts of Canada have started seeing price declines and slowing demand. While the drop may not seem dramatic at first, it introduces a serious financial risk known as negative equity. Negative equity happens when the amount you owe on your mortgage becomes higher than the value of your home. Imagine purchasing a house for $800,000 with a large mortgage. If housing prices fall, and that home is now worth $700,000, you still owe more money than the property itself is worth. This situation becomes extremely stressful for homeowners. Selling the home no longer solves the problem because the sale may not fully cover the remaining mortgage. In some cases, owners must bring additional cash just to close the deal. Now combine falling home prices with higher interest rates and rising mortgage payments. Some homeowners who feel financially squeezed may decide or be forced to sell. When more properties suddenly enter the market, it increases supply. And when supply rises faster than demand, prices can fall even further. This is how housing downturns sometimes accelerate. What begins as a small price correction can slowly turn into a broader market decline if financial pressure spreads across thousands of households. For a country where housing has long been viewed as the safest investment, even a modest drop in prices can trigger a powerful psychological shift in the market. We'd love to hear your opinion. Do you think Canadian home prices will fall further or bounce back soon? Drop your thoughts in the comments below. And if you appreciate the work behind these videos, please subscribe to the channel. It's just one click, but it helps us keep creating content like this. Number 6. Rising mortgage defaults are starting to appear. For many years, Canada's mortgage system was considered one of the most stable in the world. Mortgage default rates were extremely low, and banks often highlighted this as proof that the housing market was strong and resilient. But recently, financial reports and banking data are starting to show something different. Mortgage delinquencies are slowly rising again. A mortgage default happens when a homeowner is unable to keep up with their loan payments. At first, it may begin with a missed payment or two. But when financial pressure continues to build, those missed payments can turn into serious problems. Eventually, lenders may step in with stricter actions, including legal notices or even foreclosure in extreme cases. Right now, the number of defaults is still relatively low compared to previous housing crises in other countries. However, economists are paying close attention to the trend rather than the number itself. What concerns analysts is that mortgage stress is beginning to increase at the exact same time that other pressures are rising, such as higher interest rates, expensive living costs, and upcoming mortgage renewals. For many households, the financial squeeze is happening from multiple directions. Mortgage payments are rising, groceries and fuel are more expensive, and wages are not increasing fast enough to keep up with inflation. This combination can slowly erode financial stability. When defaults begin increasing across a housing market, it can create ripple effects. Banks may tighten lending rules, buyers may become more cautious, and homeowners under pressure may decide to sell quickly to avoid financial trouble. This adds more homes to the market and can contribute to further price pressure. In other words, rising mortgage defaults are often one of the earliest warning signs that deeper financial stress is spreading through the housing system. Let's make this discussion interesting. If mortgage defaults continue rising in Canada, do you think the government will step in to help homeowners? Share your thoughts in the comments, and if you appreciate the effort behind these deep dives, please subscribe to the channel. It's just one click, but it helps us keep producing videos like this. Number 7. Investor speculation is starting to unwind during Canada's housing boom. Not everyone buying homes planned to live in them. A huge number of properties were purchased by investors hoping to profit from rising prices. For years, this strategy seemed almost unbeatable. Investors would buy homes, condos, or multiple properties, then either rent them out or simply wait as the value increased. As prices kept climbing, many investors believed the market would continue rising indefinitely. This wave of speculation played a major role in pushing housing prices higher. When more investors enter the market, demand increases rapidly. In some cities, buyers weren't just competing with families looking for homes. They were competing with professional investors and property speculators. This created bidding wars and drove prices to levels that many ordinary buyers struggled to afford. But speculative markets can change direction very quickly. When housing prices stop rising or begin falling, investors often react differently than regular homeowners. Unlike families who buy homes for long-term stability, investors are usually focused on profit and risk management. If investors sense that prices may stagnate or decline, they may decide to sell their properties earlier than planned. When multiple investors make that decision at the same time, it suddenly adds more homes to the market. This increased supply can place downward pressure on housing prices. Another challenge investors now face is higher borrowing costs. With rising interest rates, many rental properties are becoming less profitable. Mortgage payments have increased, while rental income may not be rising fast enough to cover those costs. As a result, some investors are beginning to rethink their strategies. And if more speculative buyers decide to exit the market, it could remove one of the major forces that helped fuel Canada's housing boom in the first place. Here's a question for you. Do you think investors helped create Canada's housing problem, or were they simply taking advantage of the market? Tell us your thoughts in the comments. And if you enjoy these detailed breakdowns, please subscribe to the channel. It's just one quick click, but it helps us keep producing videos like this. Number 8. Inflation is crushing household budgets. While rising mortgage payments are already putting pressure on homeowners, another powerful force is quietly making the situation even worse: inflation. Over the past few years, the cost of everyday life in Canada has increased dramatically. Groceries, fuel, utilities, transportation, and even basic household items are becoming more expensive month after month. For many families, the problem isn't just the mortgage anymore. It's the combined financial pressure of everything getting more expensive at the same time. Imagine trying to manage a household budget where your mortgage payment has increased, your grocery bill has jumped significantly, and energy costs continue to climb. Suddenly, money that once covered comfortable living expenses begins to feel tight. This is where the real strain begins. Many households bought homes when interest rates were low and inflation was relatively stable. Their financial planning assumed that most of their income could comfortably cover mortgage payments along with daily expenses. But inflation has changed that balance. When the cost of living rises faster than wages, people have less disposable income. That extra cushion that once helped families save money, pay off debt, or handle unexpected expenses starts to disappear. Instead, more income is consumed by basic necessities. In this environment, even homeowners who were financially stable a few years ago may begin to feel pressure. Some may reduce spending, delay investments, or dip into savings just to stay on track with their mortgage payments. Others may begin to worry about what will happen when their mortgages eventually renew at higher interest rates. Economists often describe inflation as a silent financial drain because it slowly erodes purchasing power over time. And when inflation combines with rising mortgage costs, the pressure on households can become extremely difficult to manage. In many ways, inflation is quietly turning Canada's housing challenge into a much broader financial squeeze for millions of families. Quick question for you. Which expense has increased the most for you recently? Housing, groceries, or fuel? Share your answer in the comments. And if you value the time and research behind these videos, please subscribe to the channel. It's just one click, but it helps us keep making content like this. Number 9. Construction slowdowns are creating market instability. Another major factor making Canada's mortgage situation worse is something that many people don't immediately notice: a slowdown in new housing construction. When interest rates rise sharply, the impact doesn't just affect homeowners. It also affects developers, builders, and construction companies who rely heavily on financing to start new housing projects. Building homes requires large amounts of borrowed money. Developers often take out significant loans to purchase land, hire workers, and complete construction projects. But when borrowing costs rise, those projects suddenly become much more expensive to finance. In many cases, developers are now delaying or canceling projects because the numbers simply no longer make financial sense. At the same time, demand from buyers has started to slow down. Higher mortgage rates mean fewer people can qualify for large home loans. With fewer buyers entering the market, developers become even more cautious about launching new projects. After all, no builder wants to complete hundreds of homes only to find there aren't enough buyers willing or able to purchase them. This creates an unusual situation. On one hand, Canada still faces a long-term housing shortage in many cities. But on the other hand, rising borrowing costs are preventing new homes from being built quickly enough to stabilize the market. The result is a kind of market imbalance. When construction slows during periods of economic stress, it can create ripple effects throughout the housing system. Construction jobs may decline, housing supply becomes unpredictable, and price movements can become more volatile and unstable. In other words, the slowdown in housing construction isn't just a short-term issue. It adds another layer of uncertainty to a housing market that is already dealing with rising interest rates, high debt levels, and mortgage renewal pressures. And that instability could make Canada's housing situation even more complicated in the years ahead. Let's hear your thoughts. Do you think Canada needs more housing construction or stricter housing policies to fix the market? Tell us in the comments below. And if you appreciate the effort behind these deep analyses, please subscribe to the channel. It's just one click, but it helps us continue creating videos like this. Number 10. A dangerous psychological shift in the housing market. One of the most powerful forces in any housing market isn't interest rates, government policy, or even construction levels. It's people's expectations. For decades, Canadians believed that real estate was one of the safest investments imaginable. The common belief was simple: buy a home, hold it long enough, and its value will eventually rise. This mindset helped fuel Canada's massive housing boom. But markets can change quickly when confidence starts to fade. When buyers believe prices will keep rising, they rush into the market. They compete with each other, bidding higher and higher just to secure a property before prices climb further. This optimism creates strong demand and pushes housing values upward. However, when the narrative begins to shift, when people start believing that prices could stagnate or even fall, buyer behavior changes dramatically. Instead of rushing to buy, many potential buyers decide to wait on the sidelines. They delay purchases, hoping prices might drop further in the future. This shift may seem small at first, but it can have a powerful effect on the entire housing market. When fewer buyers enter the market, homes take longer to sell. Sellers may begin lowering prices to attract buyers. As prices start falling, it reinforces the belief that waiting was the right decision. This is how housing markets can transition from booms to corrections. If enough buyers pause their decisions at the same time, demand weakens quickly while supply begins to rise. Homeowners under financial pressure may decide to sell before prices fall further, adding even more listings to the market. In short, when market psychology changes, the entire housing system can shift direction faster than many people expect. And right now, Canada may be entering that critical turning point. Before you leave, we want to hear from you. Do you believe Canada's housing market is heading for a crash or a recovery? Share your thoughts in the comments, and if you appreciate the effort behind these videos, please subscribe to the channel. It's just one click, but it helps us continue bringing you deep insights like this. For decades, Canada's housing market was seen as one of the strongest and safest in the world. Home prices kept climbing, demand remained strong, and many people believed that real estate would always be a reliable path to financial security. But today, the situation looks very different. A combination of powerful forces is now putting unprecedented pressure on homeowners, buyers, and the entire housing system. We've seen how rapid interest rate hikes, rising living costs, record household debt, and upcoming mortgage renewals are creating a perfect storm. Millions of Canadians who bought homes during the era of cheap money are now facing dramatically higher borrowing costs. At the same time, inflation continues to strain household budgets, leaving families with less financial flexibility than ever before. On top of that, shifting market psychology, slowing construction, investor pullbacks, and rising mortgage stress are all adding layers of uncertainty. None of these factors alone would necessarily trigger a crisis. But together, They create a situation where small financial pressures can quickly turn into larger market shifts. The next few years could become one of the most important periods in Canada's housing history. Mortgage renewals between 2025 and 2027 may test the resilience of millions of households. Some homeowners may manage the higher costs, while others could be forced to make difficult decisions such as refinancing, downsizing, turn, or selling. Of course, housing markets are complex, and outcomes are rarely simple. Governments, banks, and central banks may introduce policies designed to stabilize the market if stress levels rise too high. But one thing is becoming increasingly clear. The era of easy money and effortless housing growth may be coming to an end. For buyers, homeowners, and investors alike, understanding these changes is more important than ever, because the decisions people make during uncertain times often shape the future of the entire housing market.